the first event of a longer series of events that try to cover all the different routes that a Greek startup can take to get funding, basically. So we're starting from venture capital, and then we're going to be moving on to private equity next month. And we're going to have an event on venture debt, and finish with revenue-based financing in May. So we're going to be covering all the possible routes for financing for a Greek startup until summer, basically. So starting with venture capital today, I'm going to take 2 minutes for a brief intro and to admit latecomers too. I'm Talia. I am a principal with Marathon Venture Capital. And this event is hosted by the Greek Tech Finance Network, which is a group of finance professionals mainly. So CFOs, heads of finance, controllers, but also investment professionals. At times, we also address founders or ops people, depending on the topic. We gather on a monthly basis, and we discuss matters of common interest, which can be, it's usually very practical items, such as tax, employee option schemes, budgeting, forecasting, fundraising, like this one. Sorry, let me admit more people. So yeah, this is usually, these are some usual suspect, sorry. There we go, more people joining. So today we start with venture capital. I said before, we're gonna be announcing more events on startup fundraising and financing via our LinkedIn group. So we start with VC today, and we're going to cover it from a more technical angle. We're going to try not to repeat the numerous events that you might have attended and the articles you might have read. So we have posted a long reading list in our event page, and you can find there some good resources. You can go through them at your own pace, and today we'll focus more on technical aspects such as metrics, how to create a VC list, and how to actually find the emails of the investors in that list, and also data room, some tips of on your pipeline Excel, stuff like that. So I guess admitting the latecomers, and without further ado, I'm gonna give it over to Myrto Papathanou. She's a partner with Metavallon.vc, and she'll take us through the basics of a VC model, the deck, and then on to metrics.
Great, thanks so much, Talia, for the kind intro, and thanks everyone for your time in attending today's session. We'll hope that we'll make it worth your while. I guess you guys can see my screen, right? Yeah, you can see it, cool. Great. So as Talia said, I'm Myrto Papathanou. I'm a partner with Metavallon Venture Capital. I'm going to start this session on VC financing, giving you a generalist view. As Talia said again, like I'm going to try not to repeat everything you can find on the web. So things that you can use as resources, such as Y Combinator, tips on putting together a deck, such as a lot of material that Marathon and ourselves have put forward. I'm just assuming that you guys know it. So I'm just going to focus a little bit on explaining what the VC model is, and then going through some specific things that really matter in your deck. Just who we are very briefly, we are Metavallon Venture Capital. We started in 2018, investing in early stage technology companies based out of Athens, Greece. We're about to launch our second fund. Our first fund was 32 million, out of which we did 29 investments. So very specific strategy on being very diverse. 8% of our founders are technical. And so far we've done 11 follow-on rounds with our portfolio companies, which means that they were led externally by other investors. Those rounds have been around 50 million of further financing. And on the right, you can see some of the people we've co-invested with since we started the activity. This is just to say that we've done this quite a few times. So we've seen a few companies, and we've also supported quite a bit the companies in terms of their fundraising. For a lot of them, it was the first time that they were looking for a follow-on round. So we also had to make the process simple and easy for them and support them as much as we can. So the first thing I want to talk about, and this is a heavy page, it is a technical guide after all. I want to say a few things about the VC model. This is not for you to understand at full, but you need to understand who you have at the other side of the table and how their business model works, right? So every time the VC makes an investment, they're looking for multiple times the value of gaining multiple times the value of that investment. And what is the ultimate goal is for investment to do what we say in our language, return the fund. So for one investment to be able to return the entire fund. These economics and the way that this works for different size of funds determines how the VCs view each investment and whether they see in it the potential for it to be successful and essentially return the fund. So I'm just going to go through a simple example. The numbers are made up, but they're not very far from the truth. So in each round, you can expect to lose between 20 and 25%, maybe a bit less if you're doing really well. Here in this example, I'm just going to assume that we take an initial investment of 1 million out of 4 million pre-money valuation. So the VC takes a 20% stake. So assuming that in a period of 3 or 4 years time, you're going to have 2 follow-on rounds after that, where other external investors are going to lead it, putting in additional capital. So here I've assumed 5 million for the Series A or C plus, whatever you want to call it, and 10 million for Series A, Series B. And the VC follows on by putting in another 1 million and another 500,000. That means if you do the calculations that you see at the end of the page, that with an exit of 70 million, which is a good exit, right? So you can't say that it's a bad exit to sell a company in 5 years, let's say for 70 million. The VC would be getting 17.2% of this value according to what they put in, or a return of 12 million. So this for a VC is a good outcome. You can't call it a bad outcome, but it's not the exceptional outcome that's going to be returning the fund. For this specific company, in the example to be returning the fund, it would need to sell for over 200 million. Again, this is just to show you what VCs are looking for every time that they see in front of them a deck. So they're trying to decipher from the information you say if this company has the potential to return the fund. And this is because many won't. But every time you make an investment, at least you're trying to have the conviction that this is a company that will actually be able to get you these returns. So if these numbers in your business model and how you see your business evolving are completely out of reach or out of order of magnitude or out of ambition, then maybe the VC is the wrong counterpart to be speaking to in terms of finance. Moving to the next slide. This again is information that you can find, and I think that a lot of people with a lot more experience than us have written a lot of things. But those elements are what you should be including in your deck regardless. So you should be looking at a problem about why this problem needs to be solved now, and this is the correct timing. Looking at the technology and the product, the market size, revenue model, team and traction, financial projections, competition, and fundraising goals. So again, all those need to be included, but I won't go too much into depth in all of those because I think they're pretty standard. What I will go through is 2 elements of these though. And if I had to choose 2 of those things, then that early investors are focusing on, and especially at when it gets to the partner level, it would be technology and team. And I'll start with technology. What is really important to communicate to your investors through your deck is how your technology is defensible, it's scalable, and it's fast developing. How, in essence, you can use what you've created so far, that even if competition comes in, that you'll be able to come out as a winner, and that you'll be able to be so fast that by the time they reach the market, with your product, their technology will already be obsolete because you have moved ahead. This is an essence of the risk that early stage investors are taking on the technology side, especially if you're talking about things that have proprietary technology involved, or they have what we call deep tech, or how you want to call it, high tech elements. And this is a risk that the investors are taking. However, you need to be able to communicate in your deck how you're going to be winning on the technology front. This is very important. And to that, and it's not irrelevant, and it's also not obvious, because I think sometimes some founders believe that, okay, if the technology is there, then the product will just follow naturally. So the product is how you translate this technology into something which is commercially viable and commercially available. And I see personally a lot of technical teams struggling with that. So a lot of them have very strong tech, but they don't necessarily translate it into a product that is viable. In your deck, you should be very clear about how this, what you're offering in the market, first of all, is valuable standalone, even from version 1.0. So someone will be willing to pay for it, even on the first version you released out there. It should be clear in your deck how you iterate the product. So how you're getting feedback from the market, testing and retesting your assumptions and redesigning the product that you have out there. And also who it is that is buying and why they're buying it and out of which budget. So all of these should be there in the first deck and relate to your product. Also, I also think that in terms of the product, you should be thinking the commercial side as well. So whenever you're inside a customer, there's an opportunity to upsell or cross-sell or get more value out of the customer. I think we'll go into more detail on that in the next presentations. However, this also relates with how you develop and with what priority. So these are elements which should be there from quite early on in your deck. So now a few things on the team. The other thing, again, if I had to choose only two things to stress out of this deck, is how you present the team. So always the belief is that the right team will execute and pivot to deliver the product to the market. And the right team is more important than the right idea, the right product, or whatever else is happening. Now, what does the right team mean? So the first thing that you need to convey, and remember that a lot of times your counterparts, so the VCs, are not industry experts. They're many times not technology experts or solution experts or market experts, and they might be seeing a number of different things every day. So you need to help them understand why you understand the problem better than anyone else. So is it that you know very well your industry because you've worked there before? Is it that the technology that you have used for another problem is all of a sudden relevant for something else and you recognize it because you know that side? Is it the actual solution? Is it the buyer? Sometimes it's important to convey why you know the process very well and why you know who the buyer is and what will trigger them to buy your product and to solve their problem. The second thing that I think is very important and all of us are looking for is proof of the team's ability to execute. And by that, I don't mean putting a nice business plan, but we're always trying to see if this team together, ideally as a team, but not necessarily if they are on an early stage, have a track record of being able to bring things forward and get from A to Z successfully with specific steps. It's very important to communicate that, how you handle things in the past, how you have proof of execution. A lot of times this is done through the track record, but if it's very early and you don't have traction yet, then you can use examples from your previous professional career, etc. The other thing I see a lot of startups putting a lot of time and energy into is building a strong advisory board and people that support them at the early stage. Now, this is nice and it's important to have strong angels, for example, or advisors. However, I think some of them are not putting enough weight on the executive team. So the most important people in the startup is the ones who will be doing the work. And even if you have amazing advisors, at the end of the day, you will be responsible for doing the day-to-day. And it's very important that you don't downplay your executive team. So the people who will be doing the job are actually the people you should be putting the spotlight on. Of course, you know, dynamics are different in different teams, but we're trying to find out if this is actually a team or just a one-person show. So if it is a one-person show, you should say it, and then it's the VCs need to evaluate that and try to do the risk analysis. It doesn't mean that it won't happen. That needs to be clear. If it's a team, then you need to be communicating who's doing what and what the relationships are between you in terms of making decisions and moving the startup forward. Another thing here, and it relates to the team, is how much gravitas, let's say, the commercial side has. So as I said, we have about 80% of our companies built from technical founders. So what we see a lot is kind of initially the downplay of the commercial side. The product's gonna sell by itself. The product's amazing. There's no solution in the market. There's no competition. There's no need to push the product because the clients are gonna come by themselves. But this is never the truth. So it needs to have a side where they appreciate the commercial side and they are treated as very important people in the team. And then of course, what we're trying to decipher in the first meetings with the teams is whether this team has very clear ownership and leadership status. So for some of them, it's not clear who does what and who owns what, and maybe it's not a problem at the beginning, but there needs to be a path and a way to discuss these and make decisions that is clear and doesn't cause a risk later. I remind you that a lot of startups don't go ahead because the founders get into fights because there are different things that people care about. So the ownership and leadership is very important. And two last points on this, I think it's important to be able to see how this team will expand. So if they can recruit, that every fundraising deck has a use of funds. If you're planning to hire 50 people in a year, then we need to understand how this team will attract, and convince all those people to come and join their team. So it's very important to be able to understand if they are the right people to do that. And the last thing is that at some point you will part as a VC from this startup. So you need to see if you can part smoothly, whether it's a good outcome or a bad outcome. It's the same thing as marriage, right? They say never get married to someone you don't want to be divorced from. So I think it's important for us to understand if we fit together with a startup, and if things go well or they don't go well, we'll be able to part in a way that everyone's happy. So yeah, just looking a little bit more about metrics, going back to the technical side. So there's, we've categorized this into 3 categories. So obviously startups have different models, B2C, deep tech, B2B, etc. And here are some metrics for each category. Bear in mind that in some sectors, it's very standard about what we're looking for. We used to hear a lot the 1 million ARR to get to a Series A. We used to hear 1 billion market. Now we're hearing a lot, how fast will this company get to 100 million revenue? These are things that are going around the VC world. My experience is that they're not always exact numbers, so it's not always exact science. And the things that relate more to the growth and the potential of the company become more important, as well as the technology and the team that I mentioned before. So very quickly passing through, regardless of what company you're running, everyone will look at your MRR and ARR, also the customer acquisition cost and lifetime value of your customers. And what's most important is if these customers are returning, if they're churning, so if they're moving away, and how fast is this happening. Also, of course, what it means to be executing this business. So how much is your burn rate, what you need to be spending in the market, regardless of what you're earning, to be maintaining what you're putting together, putting forward as a solution. So with B2C companies, we have things like conversion rate that you should be communicating, retention rate, which is how much of the customers you're keeping. And maybe even more important than those are everything that relates to growth and repeatability of the sales. So repeat revenue, customer growth, growth rate are very important metrics that you should be conveying. Deep tech is somewhat different. Here, we need to be seeing, you need to be talking about your early customers. A lot of times that they are just proof of concept. So you don't necessarily have clients as such, but you have things under development. So some of them might not even be paid. You need to be communicating your IP and how this is defensible. And also if there is a weight shift in the value chain of the specific market that you're targeting. Again, because these are solutions that take a long time, usually have very long sales cycles. You need to be clear about what is the long-term impact of those and how what you've created, which is usually based out of research and a lot of years that make it quite strong in terms of its defensibility, will be the technology and the solution that will prevail. And finally, B2B, I think you all know probably that you should be looking at the ARR and net new ARR. So what's coming new every month, the sales cycle, of course, the sales pipeline value, day of sales outstanding, number of customers, etc. So these are things that you will be asked. It's good to bring them forward. And with that, I'm gonna discuss a little bit about what you might be challenged on when you bring forward a pitch deck. So I think that what I see a lot of times when founders are pitching is that it's not clear to them what we're trying to see. So this is my attempt here to take like all the essentials that we need to put in a deck and try to explain what the startup would need to defend or explain and what from our side we're trying to find. So with regards to the problem, if it's not a real problem, it's just a nice to have, a lot of times you will be challenged on that. So sometimes this is because we don't understand the pain of the customer. So this is because the VC doesn't know the specific market and is just looking at your solution as a nice to have. So be prepared to start from the beginning and explain the market very specifically to these guys, because it's not necessarily that they know or we know what you're talking about. So technology not translating to product, I talked a little bit about that. Again, try to communicate who's buying version 1.0, how they're buying it, and from which budget they're buying it. So we need to make sure that we understand that in terms of the technology and product side. So market size, this is always a challenge because there's not a lot of data, and I found a lot of founders are struggling with that. So they're making a lot of assumptions. So I think from the VC side, we just need to understand the market disruption, if this is really a market that can be disrupted and therefore extended, and what is the end game. So the revenue model, we're trying to get the information about how the unit economics will eventually make sense. A lot of startups start with freemium models. They start with models that don't relate to revenues. We need to understand where this ends and what is the big picture here. So this is what we're trying to understand with questions on that. Theme I've covered. We're trying to understand if you know who you need and how you will get them. Tractions, in terms of traction, sometimes traction can be scatty, so it's not always like this stick that is the ideal for everyone, right? Again, you need to explain what the sales cycle are, if there are up and cross-selling opportunities, what is happening with the specific business to make the VCs comfortable with that. Financial projections, and I have a finance background, and I think you guys are all finance people. At the very early stage, it doesn't matter. So it's just I'm just checking for common sense, so that the order of magnitude is correct. As you get to Series B, Series C, of course, they start mattering a lot more. But like a seed stage startup doing 6-year projections, I don't understand how the numbers can be close to the truth either way. So I'm personally just checking for common sense. So competition, why will you win? And only you. And the fundraising goals, which is always the question of what the company looks like at the end of the runway. So what are its revenues, how it looks like, and where it stands. So this is my final slide. Do not waste your time with irrelevant investors. Some of them are not right for you because of the stage, because of the business model, because of the sector. So don't try to speak everyone, be more selective. I think Chris and Konstantinos will talk about that in a bit. Think one round ahead. Try to see who can also support you in the next round when you're fundraising and the one after that. I think that's always very helpful. Don't make fundraising a purpose by itself. So you're there to create value, not to fundraise. And getting fundraisers is fun, and a lot of founders really enjoy it. But at the end of the day, you just need to be creating value, not fundraising. That's not your job. So I think one of the other challenges is to try to use the deck communicate both the current status and the long vision. I think that's always very difficult to do because you need to be both aspirational and pragmatic, and it's very hard to do in a few slides. So please make sure you spend some time addressing that. Try to pitch to your audience. So if you're pitching to an American VC, they're used to a very different tone from a European VC, for example. So try to understand who you're pitching to and adjust accordingly, but never pitch them what you think they want. You need to pitch them what you're doing and what your real conviction is with regards to your company. At the end of the day, you'll be running it. So it needs to be truthful and authentic and honest. And final tip, you're always fundraising. Every time you speak to someone, you should be communicating your company. Every opportunity to meet someone might prove a connection later. So bear that in mind. You're always making connection. Everyone in your company is, and you're the best communicators in your company. So please use every occasion to bring it forward and all the amazing things that you're doing. Thank you. I hope this was useful. Please feel free to email me and stay in touch.
Thanks, Myrto. That was actually a very spot-on presentation on the technical aspect. So thank you for that. We have a question, which is if you have any, I guess if you have any special. So here's the thing with metrics. It's very specific and very case specific. So it really depends on the company. But we have a question whether you have something to add on B2B2C metrics. So is there anything specific that you would look at for a B2B2C company? Yeah, I guess you have to look at everything then.
Yeah, I would look at everything, but for me, a B2B2C business is first a B2B business. At least that's how I understand it. So you need to be able to be onboarding the business clients. So I would be more focused on the B2B characteristics and metrics, and then seeing the C side at the end. We don't have many of those, so I'm sure people have more. But I would primarily use it as try to evaluate it as a B2B first and then get to it.
Yeah, same here. I guess the financial metrics might be more on the B2B side, whereas you would look at the user metrics for the C side, perhaps something like that. Okay, perfect. I don't see any more questions for now, so I'm wary of the time as well. So I will proceed to Chris. Chris is a colleague of mine. We work together at Metavallon.vc Capital. He's an associate, and today he will share with you his secret sauce on how he creates massive venture capital lists, but also how you choose the right ones from that list.
Thank you, Thalia. I hope you can hear me. Let me share my screen. So I guess it would be this one. Please let me know if you see the correct one or my notes.
No, we're cool.
Okay, thank you very much. So yeah, I'm Chris Gasteratos. I'm an associate at Marathon for the past 6 years. Marathon is now a 70 million euro fund. We actually announced our extension last week. We invest in seed rounds with tickets around 1 million euros. We want to be the first investor the first institutional investor at least. My presentation is on how to create a curated list of 100 or so contacts that are highly relevant to your business. These are the people most likely to take a call with you. We have implementing this process for the portfolio companies raising a Series A round, and we believe it's one of the reasons that has helped 80% of our portfolio companies successfully raise a Series A round. Of course, most of the weight is on the founders and the great work that they have done, but it makes things easier and increases your chances to raise a Series A if you also do a work something like that we will present. So I would like to start with this one. So there is a lot of marketing, around startups. It's one of the things that make this market appealing, that make this market sexy. Startups, market to VCs and their customers. VCs market to startups, and all are creating stories about themselves, what they want to do, how they want to save the world. So everyone in this market is building a narrative, and if you don't, well, you are losing the upside. So what I will do here is an attempt to provide you with a guide on how to navigate through the marketing nonsense of VCs, shortlist, reach out, and of course meet those that are highly relevant to you. And to become more specific, so VCs may say that they focus, explicitly on a certain market, on I don't know, decentralized virtual astro mining robots for the Web4. The question here is always, have they done anything remotely relevant to that? As a VC, your portfolio tells your thesis. Otherwise, your thesis is just an aspiration on what you'd like to do. But probably, if you haven't done anything and you just stayed on your thesis, you probably have no experience on that. So, for example, Andreessen Horowitz were early investors on Coinbase. They made other crypto investments along the way, and now they have a thesis on crypto and have a fund specific and specialized for crypto. And continuing this argument, partners are the ones that make the brand. And of course, not only naming partners as Mark Andreessen here, but in general, the partners are those that they sit on the boards and help the companies grow. So you should target specific partners, and most often than not, regardless of their brand. You target the people, and you need to find the people that will sit on your board and provide actual value. So we are looking for portfolio companies that that the fund consists of, and the partners that are sitting on the boards of these companies. This is the basic premise of this exercise. Other things to look in a VC is, of course, the ticket size. Investors come on all sizes. There are seed, Series A, growth. The stages that they are operating in is, of course, related to the ticket size and the total fund size. Be sure that the investor you are looking for is investing in the needed ticket size. We will see that in more detail in a bit. So also another thing to keep in mind is to check the status of the fund. So is the fund active? Funds have an investment period, and although their partners may be active and say that we actively investing in startups, they may not because they haven't managed to raise a subsequent fund. These things happen, and the problem is that if you contact such an investor, they may their decision making will drag for many months, and if they don't manage to raise a subsequent fund, they won't end up investing in your company. So always search for VCs that have made recent investments, 12 months tops. What else? Industry focus and experience. Of course, it makes sense to speak to investors that understand your industry. It would be much easier to meet them, and of course, they will provide value to your company. What to avoid? Avoid VCs that have certain geographical restrictions that, of course, they don't apply to you. So a lot of VCs, say that we only invest in India, in China, in Greece. If you are not operating there, if you don't have, if you are not planning to have a subsidiary or a branch at least there, doesn't make sense to talk with these kind of funds. And of course, avoid VCs that have invested in competitors of yours. So some VCs may take this opportunity to talk with you that they know you are a competitor to a portfolio company, just to make due diligence on their other deal. This is something you must avoid, and you can, most of the times you can tell because they are asking way too specific questions. So what is the XYZ, the secret part of the secret sauce that helps you do that? What are your suppliers? You should avoid that, and in order to do so, you should proactively find what are these companies that are your competitors and what their investors are. So to help you accelerate this, you should use certain tools that are out there. So I would suggest to have at least access to a startup directory. Something like Crunchbase would do the work. For our example, we will use Crunchbase. Another thing that helps is, of course, to have a spreadsheet, and most importantly, a CRM. So a CRM, for those that you don't know, is a directory that you create with contacts with people or companies that you use across your team, and it gathers all the communication channels, so email, phone calls, meetings, so you can see the history of each contact and address it respectively. And also it makes sense to have a contact enrichment tool. So something like a Hunter or Rocket Reach or Clearbit. All these are indicatively. You may use your own tools and the stack that best works for you. So let's see a case study here. Let's say we have Cybersnake, a company that's raising 7 million Series A round. So they are looking for ticket sizes that are north of 2 million. Because it makes sense to, investors don't always lead. So for this specific round, a lead investor may contribute something like 5 million, 6 million, all may take all the round. The thing here is that you want to target investors that may not be your lead. And at some point you may say something like, oh, I have found 40% of the round, and I'm just looking for the lead. This is a much better position to be in than say, I have only 500K committed to a 7 million round. And of course, we will focus also on industry focus, which is here cybersecurity. So this is pretty much something like a demo on how to use Crunchbase to find companies that are related to your space. So first, you do description. It works much better than categories. Feel free to experiment with different keywords. Here, I put only cybersecurity, but others may work better. And then, you should also put a criterion like funding rounds, companies that have announced a round in the past 5 years, which is quite generous, to be honest, 5 years. Most of the times it will make sense to focus in the past 2 or 3 years. But here, because I only put cybersecurity in the description, so it makes sense to broaden the research on that front. And of course, another criterion is money raised. Here, although our case study is a company raising 7 million, we want to find all the VCs that have committed in at least 2 million, in a round that has raised, that's at least 2 million. Again, the rationale is to find the company, not only the lead investor, but also those that can be not the lead. And of course, you need to focus on companies that can be broadly be identified as startups and have, they have been founded at least after 2007. This is again very, very generous because a company that old may not be a startup, but we have seen that a lot of companies that raise money can be more than 10 years old, and after a point they get the traction, they get the customers that will enable them to raise a round. So yeah, keep this in mind. We will also have the recording. I know that's getting too technical, but I think it gives you a good perspective on how to build the first part of the research, which is to identify the companies that are in your broader space. So the past step will lead you here. So here we have our spreadsheet. We are categorizing the companies as competitor, or what we say, companions or citizens. I think competitor is pretty clear. Here we list only the direct competitors, not those that may be competitors in the future. The list of competitors should not be that long. And then you have companion, which is companies that you may partner with in the future, that they operate in your space, but they don't compete directly with you. And we also have another one that's, we call it citizen, which is companies that are in the broader market. Essentially, it makes sense to make this distinction, at least between competitors and everything else, because you want, as we said, you want to avoid the investors of your competitors. So moving on and taking every company listed in our spreadsheet, this spreadsheet we call it the competition matrix. It is time to go on and find their investors. As we said, we are targeting people, not brands. So here we are going to find all the partners sitting on the boards of these companies. Here we get each one of the companies labeled as companion or citizen, not competitor. We put the criteria as money raised, again, between 2 and 35 million, an announced date after 2017, investor type venture capital, and of course we want the venture capital to be active. And the result is the partners that have at least participated in a round of that size. So the next step is to take these partners and list it in a spreadsheet. Now you must have tens or even hundreds of names. I mean, if you think about it, a company may have a few partners on their board, and if you go through a few tens or a few hundreds of companies, times 2, times 3, here you must have hundreds of names. You also have the LinkedIn and Twitter accounts. Now it makes sense to start digging into their identity, into these identified leads, to better understand what they like, and to find areas of common interest to your prospective VCs. So for example, here, yeah, it makes sense to start taking their Twitter accounts and LinkedIn pages to get a conversation starter when you will be emailing them. The last part is to enrich the information that we have in our spreadsheet with the partners. Here we use Hunter. It finds the contact details of VC partners at an average rate of 80%. It's just a tool to accelerate things. So you have a list of partners, you have a list of emails, and you must start cold calling people. The thing here is that you can also get most probably a warm intro. Here is a founder with a spotless introduction and ask for a warm intro. This is a really excellent way to get an intro. So this guy said something like, Kalimera Chris, I don't think we have ever met, but was wondering if you know the XYZ partner well enough for an intro. It's regarding my startup. He also sent me the deck of his startups, which I co-founded, and is raising a Series A. 30% is already committed. So this is also, kind of a pitch, but I really appreciate it. Could be a good fit. We could be a good fit for this CVC, and trying to talk to someone there. Let me know, and I can send you a forwardable email. Thanks. This is how you would like to this is something that you would like to get in order to make this intro, because I mean, this guy, gives you everything, even a forwardable email. And if you have the intro, it makes sense to if you own the contact, it makes sense to make the intro. But if you don't, please don't send something like that. I mean, the problem with this kind of cold emails are very generic. Most of the times they show that you haven't put the effort, you haven't done the work, and that shows certain attributes in a person. So the problem here is that again, it's very generic. It doesn't convey any message. Something like that, like my name is XYZ, and I'm building the world's best cybersecurity platform that will help customers, what customers? Enterprise, consumers, detect and address threats online. Please let me know when to come by your offices and present my idea. I mean, an email like this may take, I don't know, a few replies that all will be disqualified. I don't think that anyone will take a call like this. The right way is to do something like this. So my name is XYZ, and for the past 6 months, we have been building a code review tool that will enable developers to write secure code. This is a nice one-liner pitch. The product is still in alpha, but we have landed a POC with a Fortune 1000 company and have inbound interest from a few more. Also, a progress report here. We are now raising a seed round, and this is a direct task. I think you will be an excellent fit for us since you are an early investor in Hack the Box and Code P2P. This also shows that the founder has made her research. Can we discuss this for 15 minutes over the phone? This is also pretty straightforward. It shows that this girl or guy respects your time. You may find our deck attached. I mean, this is a complete package. Of course, it can be a little bit longer, a little bit shorter. This doesn't affect the value that you get from such an email. So to sum up, and this is my last slide as well, in order to run a very tight operation, focus on the VC's track record, not their marketing materials. It doesn't matter what they say that they invest in. The only thing that matters is what they have invested in the past. Commit the time and effort. I mean, the person you are looking for is going to be on your board for the long run. It makes sense to be the best possible out there. So commit the time, it will certainly pay off. Of course, use the tools, they will save you time. And once again, let me repeat the process. The process is to make a list of companies operating in your space. Identify their investors, their partners, the partners that are sitting on the board, and find their contact details. I think it's pretty straightforward, and of course, then draw a reach out strategy and get warm introductions. Ask for introductions whenever possible. And again, it's a numbers game. You may contact 100 people and only 30% of them take a call. And of those, I don't know, you may get 1 or 2 term sheets. You must be perfect in every interaction. You can never know which call or meeting will be the winning one. So that's all. I know it's quite quick, and this is something that we have developed across many years. I hope that the recording will make more sense the second time. Feel free to, I will also try to get the presentation on SlideShare to to have more time to study. Yeah, any questions?
Thanks, Chris. It's actually all the presentations today are very condensed, but that's the spirit of these meetings, to stay on topic and give as much value as possible. So we had a question on the chat box. I'm going to repeat it here, just so that everyone hears it. Some people might not have been reading. So the question I often hear is whether investors sign an NDA. So they don't. No investor signs an NDA for many reasons. First of all, it's completely impractical. If you actually read an NDA, you'll realize why they wouldn't be able to sign it, even if they wanted to. But also because it's their job to have, to hear out a founder's plans and to invest in those, not to actually go through with them themselves. So they base their work on reputation. So no VC would have any investors or any companies to invest in the next day if they went around doing that. So you don't really need to worry about NDAs. But if the question was around the competitors, then I guess I'll hand it over. Okay. So to direct competitors, no, the NDA is no good there either. NDAs are, it's a legal conversation that we are dragged into, but it's not something very enforceable either. And you wouldn't really know whether the VC disclose your plans to your competitor, right? So when it's a direct competitor, I would say either avoid talking to them altogether or skip their sensitive questions. But my inclination is to keep the direct competitors really very, very, very short. So I have, Myrto.
So there's just one thing in relates to what Chris mentioned before, that you need to be doing your work on the VCs as well, right? So if someone has invested in your direct competitor, there's zero chance that they will invest in you because there's actually a conflict for them. So do not send them your information. I mean, I had someone last week send me a deck on their company. Actually, I had their advisors, which is also what you should be careful of, because there are brokers that are telling you, I'll put you in contact with VCs, blah, blah, blah. So I had their broker send me a deck, and they're a direct competitor with one of our companies. I was almost tempted to say, just read my website before you send me an email. It takes 2 minutes. It's exactly what Chris was saying, and you will know it's wrong, and you're harming your company. So there's some work to be done on that. So I wouldn't suggest going and reaching out and giving information to people who have invested in your competitors.
Yeah, and you actually pointed to another matter. I don't know how useful these advisors are for these early stage rounds. I think it's very useful for the founder to do the exercise themselves, especially in the beginning. So if you're in Series D, fine, you can of course use an advisor that can guide you through it, or Series C or even B, but anything below B is a bit cringy. If you use an advisor, it's like, you couldn't raise. So as an early stage investor, I think maybe we're a bit worried when we see an advisor reaching out.
Yeah, I would agree to that. I think, there's a time and stage, and it's not the early stage. So seed, Series A, you should be raising by yourself, and the advisors can be later.
Chris, I have a question on your stack.
Okay, go on.
It's not in the chat box, but I'm sure everyone will be super interested. So how much does it cost? How much do you need to invest in if you're a founder doing it once?
Okay, yeah, good question. So I think there are a lot of free tiers, but I mean, it's an expense on, I don't know, 100 euros per month. And you will run the process for, who knows, 2 months, 3 tops. So I think it's a great investment to make. And also, I mean, it makes sense to use the startup directory because it allows you to follow the market more closely. So you can save a list with potential, not potential, but actual competitors, and also get notified when new VCs raise funds. So things like these can really work, and they keep you really informed. in the long run.
Okay, one more. You've done it many times. How long does it take?
I would say the first time you do it, it takes something like 14, 50 hours tops. But it really worth the investment. I know that most of the times when you see something like that, it looks totally over the top. But believe me, it really worth the investment. You can also engage different parts of the team in it, especially for the competition. At some point, you will also need to do, you will need to do things that are very repetitive. But again, it's worth the investment, believe me.
Okay, thanks. We've got another question from the chat box there. So should the founders seek VC funding on early stage, assuming they can fund early operations? So we're assuming that they can fund their own operations in the beginning. Should they still seek out early stage funding, or do that later on from the perspective of course, minimizing diluting? Or would the pre-seed VC help or contribute to a better strategy? So what are your views, Myrto?
Yeah, so my very honest opinion, and I don't think it's to my benefit as a VC, is that the longer you wait, in a better position you are to negotiate, right? So there's one thing saying I have an idea, there's another thing saying I have an idea and 5 customers, and there's another thing saying I have an idea, product, and 150 customers. So the longer you wait, the better it is to seek external financing. And always the good reason to seek external financing is if you're growing faster than you can afford yourself, right? So that's a good reason. The bad reason is if you don't have any more money. Having said that, the market at the moment is moving very fast. So the danger is always that someone who's doing something at the other end of the world that's similar to yours has access to money, which means that they have access to resources, human, mainly human. But you know, the capital also brings in a number of things like the strategy you mentioned and all that. So that's a danger that you know, someone will go to the market faster and then with more tools than you do. So I think you need to weigh those two things. You need to also choose your investors, of course. Again, Chris mentioned the smart money side. I think it's very important to choose the right people for you, for your business, your sector, and your character as well. And that can bring value, but don't get like 50 again advisors or like 3 VCs to do a pre-seed round, because everyone will have an opinion. It's confusing. It's a lot more about execution and focus and iteration and market feedback at the beginning than it is about everyone sharing their knowledge and you know, acquired whatever wisdom, in my opinion.
I completely agree with that. Chris, anything you want to weigh in?
No, I think Myrto covered everything.
Yeah.
If you can prolong the period that you know you are bootstrapping, it makes sense. And the less you spend in terms of equity, the less you give out to investors early on, the better it is for you. And you know, you need to make certain decisions that will allow you to have most of the company for the founders and be able to give equity in the later stages. Also, you never know when a down round will happen or something similar. So you will also need to retain enough equity for these cases.
Yeah, that's a good point, and I'll take advantage of the more than 80 people that we have here to just share that it is. Let's hold another event on this, but let's put a note that it is unreasonable for a pre-seed or a seed stage investor they're taking on a big risk, but they shouldn't be taking on half your company. Yeah, so because then you're not able to raise future rounds. But that's just a note for this event, and maybe a good pointer for future events. So, okay. I'm going to pass on to Konstantinos. Konstantinos is an associate with Metavallon.vc as well. And he's gonna take us through the fundraising process, the data room, and give you a useful and practical pointers.
Thank you very much, Salia. Let me just share my screen real quick. And I guess you should be able to see my screen now. I focus my presentation a little bit on the process side. I studied engineering, then worked for a couple of years in management consulting. So I learned to think in boxes and in steps. And I know that a lot of people find that boring, but a lot of the times it ends up being one of the most impactful things in many cases that help organizations and individuals run efficiently and achieve their targets. So today we're going to discuss how to run fundraising as a process, and then I have a few other nuggets as well within the presentation. A lot of the things that we will discuss during this presentation have been mentioned earlier in more detail. This is more of a higher level overview. So I'm starting with the reason why it's important to run fundraising as a process. Now, according to our experience, running fundraising as a structured process with deadlines, with targets, and so on, will allow you to run it more efficiently and to secure more funding in a shorter time frame, leveraging the advantages of every step along the process, including co-investment opportunities and other advantages that we'll be looking into later on. Now, we have determined 4 main steps for the fundraising process, and it should take you around 2 to 4 months to go through all of those steps one by one from start to finish. The first step is preparation. Second step is approach and pitching. The third step is the term sheet and the negotiation, and finally it's closing the deal. Now, each of those steps has its own sub-steps, let's say, and we'll look at each of the steps in the next slide. What you should bear in mind is that fundraising is a process that requires some significant time commitment from the management team. So as a rule of thumb, you should expect the CEO and the CFO to devote around 50% or more of their time during those 2 to 4 months of the process in fundraising. And I mean, it's very easily understood that if this is not planned correctly, the regular course of business might suffer. Plus, it's even worse if you don't run it as a process and it's all over the place and it's prolonged into a much wider time frame, right? So let's start with preparation. Now, preparation is important because a lot of the times you're going to be asked for a lot of details, to provide a lot of details about your company, your startup by investors. And again, a lot of the times the questions that investors ask are pretty similar, as well as the material that they want to see is pretty similar among different investors. So if you have prepared material beforehand, you can save a lot of time in the other steps of the process. So the first thing that you should do is you should define the type and the detail of the round, and this will also help you very much with also identifying the investors that you should be looking for, as Chris mentioned earlier. Then you should prepare the material, and I mean there are some standards here, and I mean most companies and most founders they prepare the pitch deck and they prepare their product material and so on, but there is also some material that is often overlooked. And this includes, for example, the sales pipeline, or having a more detailed hiring plan for your HR needs, or a comprehensible financial projections model. Once you have prepared all of this material, you should deposit everything into a depository or a website, which is the data room that Thalia was referring to earlier. And after that, the final step of the preparation stage, which is the internal stage, let's say, because most people involved are part of the company, and there are not many externals involved in this phase, is to do the testing and the dry run. So essentially, that is practicing your pitching, and you can do that with your friends, with your advisors, with VCs that you might have relationships with. After that, actually, let me just give you some examples. These are actual, on the left-hand side, it's an actual checklist from one of our portfolio companies that has been preparing for a follow-on round. And you can see they have all the material there that they want to prepare, and all of this material is then stored into the data room. And on the right-hand side, you have the actual data room by one of our companies that has very recently raised a Series A round. And you can see that the material is, there are a lot of similarities. This is how your data room should also look like. It should be structured, and it should be easy to navigate by the investors. Towards the bottom left is an example of the sales pipeline. This is like it is a template of HubSpot, but even this view, it's very useful to have. So especially for B2B companies, having a list of their sales leads and having the deal size and the probability of the deal happening, and what's the deal stage, is very important for the investors to understand whether your financial projections could materialize, and understand where you stand with regards to your sales. Now, moving on to the second step, which is approach and pitching. So you start with the fund approach, and this is everything that Chris said is spot on. He covered this exact step in the best detail possible. So you should prepare your list of investors, and then you should reach out to all those people. Again, warm introductions are important here, and VCs, they tend to be more receptive to opportunities that come from people that they trust. And these people might be your existing investors, or your advisors, or even you when you start building a relationship early on, or other companies that they have on their portfolio. So even when you speak with other people with the ecosystem, you should make sure that you cultivate these relationships so that you can get those warm interests at some point, right? But then again, you can be bold and just send cold emails, but this is not going to work most of the time. Now, with regards to the pitch deck content, this was documented again by Myrto. So I'm not going to go into detail here. And the final step is all the iterations and all the back and forth that you're going to have with the funds. So after you pitch, there's generally some process taking place within the fund. So for example, you might meet with the associate at the beginning, and then they might ask for some information and schedule another meeting with the partners. So there's going to be some internal review and some iterations and back and forth between the fund and the startup. The next step is when you receive the term sheet and when you enter the negotiation. So what does receiving a term sheet mean? It means that there is an investor who is willing to lead your round. And in this case, you should do your own due diligence on the investor. It's not just the investors that should do due diligence on the startups, but you should also do this thing and try to find out about the investors by, for example, by asking them for references through their portfolio companies, or asking people that you know that are common connections, and so on. Then you can use it to find potential co-investment opportunities, or you can communicate that to other lead investors. But what you need to understand is that term sheets, they do not, they're not in effect forever. So you have to decide whether you want to accept that term sheet or whether you want to pass and try to find other lead investors. So it's not something that you should be using like to create some competition and so on. It won't work in the longer run, right? Now, with regards to the negotiation, again, as Chris mentioned, this is a long-term partnership that you are entering, and with this regard, you should not be negotiating. You should be negotiating having that always in mind. So while these financials are important, there are also other things that you should make sure to take into account, and these are how you fit, what your fit with those people, what strategic value they bring to the table, if you are aligned on the long-term objectives of the company, and you should be bold on the negotiations, but you should be nice with the people, because it's very important in the event you end up with a deal. The final step of this process is closing the deal. It starts with the due diligence, and this is a lot of times this is done by both the fund and some external consultants. So some parts might be outsourced. Due diligence is an in-depth audit of your financials, your books, your accounts, of your legal affairs, so contracts with vendors, with customers, and so on, and of your technology. And then the final step is closing the deal, and this means translating the term sheet and the 2-page agreement that you have negotiated into a 50-page legal document. So lawyers are very much involved in this final step, and the deal becomes effective when the closing conditions are met, and this is effective until the next deal, until the next round. And the next round, most of the things that have been agreed on the contracts, on the SSA, on the articles of association, they're probably going to be renegotiated and renewed by the new lead investor. So we have also prepared the case study, which I believe showcases the importance of running fundraising as a process. And in this case, we will look into Ferry Hopper, which raised a follow-on round in early 2020. Now, Ferry Hopper managed to raise this round in 5 months, but between January 2020 and May 2020, when the deal closed, a lot of things happened. So there was a major event that really the business of the company, around mid-March, there was a lockdown and the travel bans. So by running the fundraising process proactively, they managed to secure funding and then be able to focus on the core business and on mitigating all the risks of this major event, which disrupted their business essentially. So thank you. This was my presentation. Happy to answer questions.
Konstantinos, thanks a lot. I really liked the part where you listed all the materials that should already be prepared by the founders. And so it always looks nice, you know, when you get a fast response from the founder, and it doesn't take 2 weeks for a pipeline Excel to come in after the pitch, right? So we had the question in the chat box with regards to percentages and whether you can, whether if you have a very good product market fit, you can get a lower percentage. And you also mentioned negotiating for deal terms as well on your presentation. So I just felt like saying that there's always, it's nice to be an early stage investor because your interests are very much aligned with the founders. So you don't really have to get into that negotiating so hard. So it's a very simple VC model that Myrto presented. So you need that to be interested in the company, right? And then you also want your founders to be incentivized. So you wouldn't invest in any case where the founder is already very much diluted. So whereas I understand the stress of dilution that founders go through every day, it doesn't make sense to optimize for small percentage points when you're in an early stage round, right?
Yeah, I have to agree. As you mentioned earlier, early stage funds, they don't look to dilute the founders too much. So terms are pretty much standard. The market is pretty much standard. So while you might see some divergence from case to case, there's not too much interest in negotiating too much, I would say.
Yeah, I think it's not material whether you get, at the end of the day, you're building something big. It's very early, right? And I have another question that was sent to me in LinkedIn, but I think it's actually useful for everyone to hear. So it's very often, especially when we deal with enterprise tools that we here at Marathon look at often, and you guys as well. So very often you have a case where they start off with consulting, and then there's a product as well that they're working on, and eventually they want to work on the product and skip the consulting part. And then, of course, the claim is that it is unrealistic to expect the consulting part to go away altogether in the beginning. So this is something we've seen a lot, and it's a very common case. So I guess the question is, with regards to the SaaS product and the consulting part, what does the VC expect? Where should the focus of the team be? Should they how should they treat this split of efforts, basically? So you can take the question, and anyone else can comment afterwards.
Yeah, actually, Myrto says something that is she often says that, that startups should be able to grow their revenues much faster than their costs grow. So this is in essence what scale is, and consulting doesn't allow companies to scale their revenues without scaling their costs at the same time, because you need people, right? You need people to run the projects. So, I mean, to be considered a startup that can scale, you have to have a plan to migrate from the service to the product. I think this is my view. It's understandable that this can't happen from one day to like from day one to day two. But there should be a concrete plan to do that within a reasonable time frame to be considered a startup?
Thanks, Konstantinos.
So we see that a lot, and I think it's a good question, and thank you for bringing it here, Thalia. So we see that a lot, and a lot of it relates to how fast you can switch to a product side, because again, you need to be a product company in order to be relevant for the VC side. We don't think that it needs to happen overnight. However, it needs to also be the goal of the founders, because some of the founders actually don't want to do it. So they see a lot of value in the customers or what they're doing, and it's maybe a good, lifestyle business as well. So it needs to be very clear to them that this is the way forward. And sometimes it might also be painful. It might mean that you need to say no to some projects, and it's very hard to say no to a client. But if you're focused on the product side and trying to transform the company, you have to be disciplined enough to say, okay, it's it's month 20 or 18. This is a no, because it doesn't help me develop a product more, or it doesn't add to that side. And I think that's hard. And I also understand the founders who, are struggling with this. But it needs to be clear that if you are looking for the kind of high growth model, you need to be dealing with the product, and the sooner you can do the switch, the better.
Yeah, and if I can add something here, first of all, I totally agree with Konstantinos and Myrto. I would say sometimes it depends on the product. So it's another thing to have a heavy enterprise offering. And it's another thing to have a self-serve SaaS product. So in the second case, it makes sense, to do it as fast as possible, because if the thing you want to build is totally self-serve, sticking on the past model will only drag you down. And of course, you have a burn rate and a runway. So in a year or 18 months, your funds will be out. And it makes sense for you to accelerate your efforts on this front. And it's a risk, of course, but it's a risk worth taking. On the other hand, if you have an enterprise offering, that we see that most of the times that comes, the product offering comes along with some services. These services can be, support, or some kind of not exactly tailor-made integration, but at least some fitting on the company stack, some connectors. In this case, everything that you will create as a service will also remain as the IP of the company, and you will be able to use it to your next customer. So it's not exactly scalable, but also, in enterprise, the contracts are in tens of thousands, probably hundreds of thousands, even millions. So it makes sense to make some things that don't scale at first, in order to get these clients and make them happy and use your product, and make them your marquee customers at some point on your website, and go on and raise more money and stuff.
Thank you. Also, it seemed like a good question to take. Then everyone wanted to discuss this question. So let me bring up something else, a part of the longer conversation on dilution. But so I guess a founder, as Myrto said, founders should be diluted like 20, on average, 20% every round, right? So an angel round in no case should go above that before seed or a pre-seed fundraising. If we're talking about the 1 or 2 angels or an accelerator, then we go even lower. In a good market, you can just give out like 5%. Yeah, in terms of ESOP for founders, so employee shares that you set aside. It is common. Let's start from there. It's common pre-money to account for some shares that will be awarded to employees. This is important for the company to be able to attract talent, and it is usually done on every round. So you don't just do this once. If you raise again, you're going to be asked again to increase your ESOP a bit. So this is another dilutive factor for the founders, but also for the early stage investors as you go through rounds. So what is your view, guys? What should the option pool look like in an early stage round? And what do you think when when a founder has a low percentage, do you think a portion of it could be allocated to a founder or not?
Sorry, can I just add one thing before going to the ESOP? So sometimes what we see in very early rounds, before the pre-seed rounds or angel rounds, essentially, are some in some cases are some uncapped rounds with discount on the next round, so convertibles essentially, and this can be one way to protect founders against dilution at the super early stage where it's difficult to have a valuation in place, right? So for a super early round, before even before pre-seed, you might opt for an uncapped convertible.
I'll quickly address the ESOP thing. It's another good question because it comes up a lot with the VC question. So I'll give you a range. I think the lowest ESOP we've demanded is 8%, and the highest we've demanded is 25%. The 25% was on a single founder. And also, actually, we only have 2 single founders out of the almost 30 companies. So you know, when you have a single founder, for example, and for some reason you found that you think that this is a person who's extremely strong and can pull this off, he or she should obviously get the right team on board. So this will be reflected on the ESOP. The standard is about 10%, I would say, 10, maybe 12%, something like that. But the truth is that founders believe that the ESOP is kind of theirs, so it brings a lot of conflict later on. So I find that founders, for some reason, don't treat the ESOP as it's a tool for them to attract the top people as they grow. They treat it as kind of like shares that they have, and maybe it's set aside, but maybe they'll get them back, etc. So I think that it should be very clear to the founders that this is there to help your company. It also dilutes your early investors as you move on. So you should bear that in mind. It's also not, the investor is not getting the stock, your employees are. And what I've seen a lot is that for this pool to be used in later rounds to correct things that were wrong in the first rounds. So if you have cases, and it very much happens, especially in the pre-seed and angel rounds, that you have wrong percentages, which leave the founder at Series A very low percentages, then you can use this pool. Sometimes you can also use, buying back very early investors and kind of correcting the cap table in order to bring it to a more investable and balanced stage. So I think it's a good tool. I think it later on, when you need to attract like a top CMO, for example, you need to use that because it actually has value, and this is what the market is at the moment. You need to be attracting top talent, and I think it should be used for what it is. So attracting top talent, sometimes correcting previous mistakes in the cap table, and not something that's a side, but maybe it will end up back to the founders or something. So yeah, that's my piece.
Thanks. So correcting the cap table, that's a future event for sure. And how much can you actually correct the cap table? Which brings me to the next question in the chat box. So let's say you have a company and the product that is growing within that company, and you want to spin it off, basically. Is it better to get VC money early on in that case, so that the mother co is sort of limited in its participation of the spin-off, and that the team that is actually joining the spin-off gets more equity in that case? So what's your view on that?
Yeah, if I may, we haven't seen such a case in Marathon. At least we haven't invested in such a case yet.
And there's a reason.
But yes, the reason is because it makes things very complicated to have a mother company. It has happened before. What we see happening in the Valley and in other more developed markets is that, you know, a few employees may leave the company. They may take with them some IP under certain agreements, and you know, develop this IP as a new company. So, for example, there are companies like Confluent, which went public last year. They develop Apache Kafka. They are the creators of Apache Kafka. So the founders of this company were senior developers in LinkedIn, and they develop Apache Kafka to be used inside LinkedIn. At some point in 2012, they decided to leave the company and start the other one, Confluent. So they have an agreement with LinkedIn to take this IP and make it their own. I'm not sure whether LinkedIn received anything back. I cannot recall something like that. But in any case, the most important thing here is, of course, to have everything clear in terms of IP. And of course, you know, it's also pretty debatable on what exactly consists the IP of a company. It's one thing to have, you know, a complete framework or libraries or other tangible assets you use on your daily work in order to in order to help the company. And it's another thing to have some, let's say, more abstract things like processes or like ideas that you are working on in your current company. These things are difficult to materialize in a deal. So if you are working with more abstract things in your company, most of the times it's not the IP of the company. Or, you know, a few companies also may say something like, oh, you use, I don't know, our computer to do the early steps in your startup. So you use our equipment. This is something that we provided you. I'm not sure whether these things are really enforceable. So it really depends on the case. As we said, it makes things complicated. And you really have to understand what the spin-off consists of. What are the key things that it takes from the mother company and wants to spin out.
Yeah, thanks. I would also say that assuming you have a standalone project, a standalone product, and a standalone team that can support that product, you need to also, apart from IP, secure that the mother co understands that it's better to own a very small part of something big rather than owning a huge part of something that's not going to go anywhere. So if your mother co-owns 51%, you're not going to go anywhere. So they have to assume a position of a small angel investor and maintain a reasonable percentage, which is again in the stages below 20%. I would be glad to hear like 8 or 10 or even lower. That's my view.
Yeah, I agree with most of what was said. So I think we see that some cases we've never invested in one so far, mainly because the ownership of the mother company was too high, or the expectations of the mother company was too high, or the structure altogether was wrong. So people were doing some parts, but borrowing resources from the company and using some people and also getting involved in projects, etc. So if there's a clear separation, and this is reflected in the cap table, maybe even the physical space and everything and the roles for sure, then it's something we would be considering. But in general, it makes things a bit more complicated.
Yeah, thank you, Myrto. So I see no more questions in the chat box. We've gone a bit overboard, but I'm glad that we covered many questions and that we thank you very much for the presentations that you gave today. I think everything was spot on, guys. And I'm just going to say that we'll be announcing our next event on private equity sometime in the next couple of weeks. We're going to have international speakers this time because we don't have this many, this kind of developed ecosystem here in Greece of later stage investors, but hopefully in the future. So for now, we're going to have some colleagues speak to us from European private equity funds. And in the meantime, you can stay tuned in our LinkedIn page. We're going to post a video of this presentation as well. So thanks everyone, to the people that hung around with us this late, and to our presenters as well.
Thank you very much.
Thank you, Thalia, for organizing.
Thank you.
For
Bye.
Thank you very much.
Have a nice evening, everyone.